you're responsible for you and your people, and I'm responsible for me and my people. If something ends up happening and one of your people gets hurt and I end up getting sued, having that additional insured endorsement on your policy that names me as an additional insured allows your program to provide the defense cost protection. That lawsuit goes back away from me and back onto your insurance program. And so it's super important, A, because it makes the contract work.
Yeah.
But B, it's the protection that you need so that you're responsible for the things that you're expecting to be responsible for and not taking on additional liability through poor contractual management or just a horrible situation.
Welcome to An Ounce of Prevention, the podcast. At our recent associates, we believe that an ounce of prevention is worth a pound of cure. Our daily commitment lies in informing our clients about legal risks without hindering their business objectives. As we like to say, we're in the business of building companies and helping executives sleep at night. So stay tuned. Maybe you'll learn something that'll help your business grow and thrive.
Hi, I'm Rachel Reese. Today we're welcoming back Phil Lukefahr. Phil serves as Senior Vice President within the Natural Resources Group at CAC Specialty. CAC Specialty is pretty cool. They're 100% employee-owned with 25 offices nationwide. They've got over 5,000 clients and approximately $2 billion in premiums every year. So I'd say Phil knows what he's talking about. Welcome back to the podcast, Phil.
Thank you, Rachel. Great to be back.
Yeah. Well, the first episode was so great. We just had to have you
That's
back.
right. That's right. High reviews.
Yeah, exactly. Okay, so today we're going to be discussing how to read a COI. But stick around afterward for our much-loved case law update. All right, so we have a lot of clients that are a new team, and they've brought on their first asset. They're starting up their MSA program. And when that happens, I try to teach them all about reading a COI. Because, and for those of you who don't know what I'm saying, a COI is a certificate of insurance. Because it's something that not a lot of folks get taught during their career. But when you're running a lean team like that, you wear a lot of hats. And so someone's going to get stuck looking at these. So today we're going to talk through a COI and explain how to read one. So for this discussion, we've provided a PDF in the show notes of a typical vendor certificate. So you can go ahead and pull that up.
Attention, all you deal makers in the Houston area. Get ready for the inaugural Deal Makers Haunted Hall Gala on October 23rd at Meow Wolf Radio Tav. It's going to be a night of networking, giving back, and some spooky thrills. The Deal Makers Haunted Hall Gala is your chance to meet with industry leaders while making a real impact on the communities we serve. This event isn't just about fun, it's about giving back to those in need. We're looking for sponsors to help make this event a success. With sponsorship levels ranging from $2,000 to $5,000, every contribution goes towards supporting local communities and making a difference where it matters most. The more sponsors, the greater the impact. We need your help to make this unforgettable. Visit www.rreeselaw.com for information about events, tickets, and sponsorships. Email rlamphere@rreeselaw.com to sponsor and be a part of something bigger than just an event. Let's make Halloween one to remember. Dealmakers Haunted Hall Gala, where the networking meets charity in the spookiest way possible.
All right, so this is a certificate of insurance, and these are usually requested as proof that the company has the coverage that they're supposed to have. They're typically one of the items that gets requested when a contract is first signed, but one of the things that people don't realize, it's not a guarantee of future coverage. Phil, can you tell us why that is?
Yeah, absolutely. It's actually interesting. If you look, for those that are listening on the podcast, sort of a third of the way down, there's a coverage certificate number and revision number section. Mm-hmm. The very last sentence there says, limits shown may have been reduced by paid claims. So even the certificate itself is telling you that what we're evidencing here may not be what's actually available to you via the contract that you're executing. Mm-hmm. And so we tell our clients often, you think about it almost like a bank snapshot of your bank account. There may be $1,000 in there today, but that does not mean it's going to be in there on December 31st type thing, right?
Absolutely. And it doesn't mean you didn't change banks.
That's right. Exactly.
So you can cancel your policy, you can move somewhere else, you can change your limits, and unless you're getting updated certificates of insurance, you may not know that.
That's exactly right.
Okay. So before we get into the coverages listed here, let's start at the top. So the producer in the top left, who's that?
So the producer would be the agent that is authorized to that basically placed the policies that you're referencing within the COI. Mm-hmm. So in this case, CAC Specialty.
And then to the right, we've got 4 insurers listed, insurer A through insurer D. Explain to me what's going on here.
So this is just kind of a high-level summary before you get down and figure out who's doing what, of which insurance companies, are sort of providing the insurance for the certificate provider here.
Okay.
And then if you look sort of on the far left, on the next section down, there's a small column that shows the letters, the corresponding letters. You see the 3 A's, B, C, 2 C's, and a D.
I do.
And so those are the corresponding markets that, obviously Berkeley here writes the general liability, the auto liability, and the first layer of umbrella.
Okay, great. All right, so let's talk about coverages. We've got a table structure here with columns and rows. Let's start with the column headings. Can you take us through those?
Absolutely. So we noted the letter a second ago. Type of insurance is basically your policy. So you've got, general liability, auto, umbrella, workers' comp, and then if you flip back another page, there's some additional coverages that are noted. The additional insured and subrogation waiver, those are very common clauses in basically every MSA that you're going to enter into. And so this is just confirming that these policies have those endorsements,
Yep.
Which is important. Then, of course, you have your policy number, your policy effective date, and then on the far right, you basically have the limits that are available, for each policy. And you can see here as an example on the general liability, there's sort of some subcategories that are unusual, but are sort of listed out in that fashion.
Okay, fantastic. So that's our general structure. And then we've got, like you said, the types of coverages listed in the rows. The first one listed here is Commercial General Liability, which is a big one. So why don't you pause for a minute and tell us about CGL coverage?
Yes, it's a huge one. So your CGL policy, your general liability policy, is what's going to respond for any third-party bodily injury or property damage that you or your entity causes. So
Yep.
that could be what we call sudden and accidental pollution event. That could be a wildfire that starts as a result of a lightning strike. There's tons of examples that it could be. And so the general liability layer is going to be the first $1 million of protection for any third-party bodily injury or property damage.
Okay.
From there, of course, so what we call them your primary layers.
Yeah.
So your primary layers would be your general liability. Next to that, you would have your commercial auto, and then your workers' comp. Your umbrella and excess layers sit above those, and they follow the policy form. So it's not any new language, or shouldn't be. Call me if your broker doesn't have follow form language. And so that's where you get your additional limits. So your GL policy, if you had a $20 million loss, let's say, your GL policy would pay the first $1 million, and then $19 million of your excess layer would respond to get to 20.
Okay,
If
great.
that makes sense.
So we covered a lot of things here, but we'll kind of back up and kind of tick off the boxes. So first off, tell me about claims made versus occurrence based.
Yep. It's a great question, and it's sort of slowly becoming, I think, less relevant in the energy insurance space. But it's basically a function of the way that the policy responds in the event of a claim. And so an occurrence policy is most common, certainly for a general liability policy. And what that policy states is let's give a real world example.
Sure.
Let's say that last year, my company got into an auto accident. It was at fault. It's on last year's policy. We hadn't been notified of any sort of court filing or lawsuit, and then we get served today. Even though I'm on a new policy period today, right, I've renewed, I'm with maybe a new set of carriers, whatever it might be.
Yeah.
The previous policy writer is going to cover that claim because it's a matter of who was on the risk when the claim occurred.
Okay.
Hence the name occurrence.
Yeah.
A claims made policy is who was on risk when the claim was submitted. So it's weird from a claims made standpoint. You could be a new company writing this business and paying a claim, that occurred 5 years ago that somebody else, received the premium on when the loss actually occurred, right? So we see claims made most often in our pollution or environmental policies. Those are most of the time claims made. And then directors and officers tend to be claims made. And the thing you have to be careful about in a claims made situation, particularly when perhaps you're winding down an entity, because of the nature of it's when the claim comes in, you have to buy what we call a tail cover. And so it's a way to sort of extend the policy coverage terms and conditions for 3, 5, 7 years to make sure that you're buying more time for that policy to sort of provide coverage, because again, it's a matter of when the claim gets submitted, not when did it occur.
Yeah, and you don't want to not be covered.
Exactly. Particularly if you're on the board of a nice, profitable exit. The last thing you want is be dealing with a D&O lawsuit later on down the road, right?
Exactly.
Yeah.
Exactly. Okay. So let's skip over then to the policy limits.
Mm-hmm.
So we've got limits for each occurrence, but then we also have the general aggregate.
That's
Can you
right.
talk us through occurrence versus aggregate?
Yep. So occurrence is sort of any one loss. And so as an example, your general liability actually gives you a $2 million aggregate, $1 million per occurrence. So you could have two $1 million losses before your GL would be exhausted. Your umbrella is all going to be on an aggregate. And so essentially what that means is that as claims are coming in, that limit's getting eroded. And so if you buy $25 million of aggregate limit, you could, in theory, have a $26 million loss that would be completely paid. And then you've exhausted your limits, and then we have to go have a separate conversation about what to do next. But
You got to go see Phil.
that's right. That's right. Yeah, exactly.
Okay, fantastic. So the next row here is the automobile liability. Like you said, it sits next to the CGL. It follows that same kind of format. We've talked a little bit about umbrella liability. Can you stop here quickly and tell us the difference between excess and umbrella coverage?
Absolutely. There basically is none. We typically call the first tranche of umbrella that sits right above the GL and auto the umbrella.
Yeah.
And then anything that you purchase from there is excess of the umbrella.
Okay.
It's all the same coverage form, language, and everything. It's just a weird insurance nuance, I think.
Okay, so it's all kind of shooting straight up the stack.
It's all shooting straight up the stack. Exactly.
Okay.
Yep.
Okay, so then we've got a row here on workers' comp and employers' liability, which is much the same as what we've been discussing. But I want to move on to additional remarks, because this is one of the things that really gets overlooked when someone is reading one of these for the first time. So it starts at the bottom of page 1, right above where it says certificate holder. But what people fail to do, and what we're going to do really quickly, is look at the second page, which in this example is actually over a page of additional comments. So you created this example for us. Thank you again for doing this. So why don't you walk us through what you'd like to cover on this page?
Yeah. So I think, this is interesting. This contract called for evidence of $100 million worth of excess limit, which, first of all, you just can't even do that on the, little grid provided. So
Right.
It's always interesting to look at the additional remarks, because typically there's going to be some level of overflow just because the certificate is so antiquated and not really fit for purpose. But you can see here, it's interesting. You're getting a lot of data. You can see sort of the way that the excess limits are stacked and how you get to 100 million. You see the 25 excess of 25 and then the 50 excess of 50. It's always interesting to see how things are structured. As an example, I would be a little bit more nervous with a placement that had, call it 3 or 4 insurance companies making up the 50 excess of 50.
Okay.
It's nice to have one company. If a claim comes through, it just makes the claims handling process so much smoother and easier. So little things like that can matter. But then, of course, here you have super important coverage, which is the energy package, which is going to be your
Very important.
control of well, all the equipment that's out on site. There's some pollution coverage in that as well, right? And so, there's no place for control of well on an Accord certificate. They don't even probably know what that is. So, you're just always going to get a lot of interesting detail here. And you can even see, I don't know why D&O would have been requested as a certificate, but even down there at the bottom shows the D&O limits, purchased, et cetera.
Yeah. So what you're saying is always read the additional.
Absolutely.
remarks.
It's where you can customize everything and get kind of some real meat behind what the certificate is showing otherwise.
Yeah, fantastic. Okay, so there are a few things I want to touch on before we go. We've mentioned this a couple of times in passing, additional insureds. Additional insureds are so important in the energy space, but can you talk us through additional insured versus certificate holder versus named insured?
Yep. So let's start with the easiest, which would be a certificate holder. That really can be anybody. Most often it's going to be somebody that you've engaged in an MSA with, but it could be your lender. It's going to be your, if you're leasing a space, it's going to be your real estate.
Yeah, my landlord has
Your
one.
landlord.
Yeah.
So anybody that needs evidence that you're sort of abiding by the contractual thing that you've entered into is going to be a certificate holder. And we talked about certificates on our previous episode. Cert doesn't mean very much, but that's who that is. The named insured is the policy purchaser and the person that the policy is initially sort of drafted and put together to protect. The additional insured is an endorsement that we would add. And the reason that it's important, if you enter into a knock-for-knock indemnity contract, which is what I'm certain your firm is recommending.
Yeah.
You're responsible for you and your people, and I'm responsible for me and my people. If something ends up happening and one of your people gets hurt and I end up getting sued, having that additional insured endorsement on your policy that names me as an additional insured allows your program to provide the defense cost protection as well as basically handle, like, that lawsuit goes back away from me and back onto your insurance program. And so it's super important, A, because it makes the contract work.
Yeah.
But B, it's the protection that you need so that you're responsible for the things that you're expecting to be responsible for and not taking on additional liability through poor contractual management or just a horrible situation.
Well, the other great thing about additional insured coverage is if the company that you have the contract with is no longer around when this claim happens, you just go to the insurance company.
Exactly.
Right? You look on your COI.
Yep, that's right.
And you call them up and
That's
say,
right.
hey, I'm an additional insured on this policy.
Yeah, and I need you to respond. Yeah, that's
Exactly.
exactly right. That's a great point. That's a great point.
Okay, so the last thing I want to mention is policy dates. So this is actually a question for our listeners. You get the certificate, great. It says they have the coverage required and the policy doesn't expire for 6 months. Well, what happens in 6 months, right? Who in your organization is making sure that the policy gets renewed and that you get a new certificate? Phil, I know there are a number of ways to do this. How do your clients typically handle this?
Yeah, I think, first of all, it's kind of a natural part of the renewal process. We will always have a preset list of certificate holders that, as we're putting everything together, we're issuing. We do one of the largest drilling contractors on the planet. You can imagine how many certificates they have. And so that's a massive undertaking. So a lot of companies they've kind of got that in an organized fashion. And so it's easy to sort of, as the renewal is coming together, the certificate process goes. We also will go in and basically use our clients' log on with an ISNet and manage sort of all of that for them too. I know you're not asking what we do, but I'm going to tell you what we do.
No, but that's fantastic because not every company is doing that for their clients.
Yeah, so it's we want to take that burden. It can be very burdensome, particularly if you're on the contractor side, and so we want to take that burden off of our clients. But equally, yeah, I mean, there's somebody typically that's part of their 18th hats, as we alluded to earlier, and but a certificate request come in, and maybe you're looking at doing work with a new operator or whatever it might be. We're constantly sort of issuing those on an as-needed basis. So.
Yeah. And you mentioned ISNet. There's a lot of great softwares out there like Veriforce or what have you that can, if it's set up properly, remind you of these things.
That's right.
But one thing I will say is that at RRNA, we do contract administration for some of our clients. So that means once the MSA gets signed, all of the requirements are put into a Veriforce or an ISNet. So our clients are getting that sort of hands-on service that you can only get if someone is actually following the contract and making sure that all the boxes are ticked.
Yep.
But it sounds like you maybe are helping to fill that gap as well.
Maybe. Yeah.
That's fantastic.
Yeah, likewise.
Yeah. Okay. So Phil, any final thoughts for our listeners?
No, I don't think so. Just thank you again. I've really had a great time doing this, and it's been fun.
Yeah. Thank you so much for coming.
Absolutely.
Talk to you soon.
Okay.
And now for another one of our much-loved case law updates. Here's a case we've been keeping an eye on, and if you're a mineral owner or a mineral manager, you should be too. Today's case is a recent ruling from the Fifth Circuit Court of Appeals called Franklin versus Regions Bank. This case stems from a leasing error on a mineral-rich property atop Louisiana's Haynesville Shale, one of the most valuable natural gas formations in the U.S. The plaintiffs, two lessors, sued Regions Bank, the entity responsible for managing their mineral interests. The lease at issue contained a Pew clause and a depth severance clause that would have required a release of acreage and depths that weren't producing after the primary term ended. In 2007, according to the court, a Regions Bank landman failed to proofread a lease extension and inadvertently extended the lease across all depths in the entire tract when the lessors only intended to extend the lease rights to a small, non-producing portion of the tract. Around the same time, PetroHawk Energy approached Regions Bank, seeking to lease the deep rights that would have been released without the extension. However, because the landman had already extended the original lease across all depths, the mineral owner lessors missed out on a more favorable lease bonus and a higher royalty rate from PetroHawk. That error created significant legal and financial headaches for the lessors, especially after hydraulic fracturing unlocked the lucrative deep shale reserves in 2008. The plaintiffs sued Regions Bank for breach of contract, alleging that the bank's landman mishandled the lease extension and cost them substantial financial opportunities. Specifically, the plaintiffs alleged that Regions' mismanagement forced them into a less favorable 20% royalty rate under the original lease rather than the 25% rate that they would have earned under the agreement with PetroHawk. The district court found Regions liable for breach of contract, but this matter has been pending with the courts for over 17 years. While the Fifth Circuit also included an analysis of post-production cost language under Louisiana law, the issue before the court that we will focus on is whether the damage calculations should reflect actual loss data, which would of course have been supplemented as time goes on, or whether the court should only consider the original data submitted, which included an estimate of future damages. In assessing damages, the district court relied on projected losses rather than actual historical data, which resulted in a judgment that was deflated by millions of dollars. The Fifth Circuit reversed this approach, holding that Louisiana law requires actual loss data to be used whenever available. The case was remanded for recalculating damages based on an updated, real-world production figures rather than speculative projections. So why does this case matter? This ruling serves as a critical warning for mineral managers. Even a small oversight in lease extensions can have multi-million-dollar consequences, especially when producing in prolific regions like the Haynesville Shale. And even though the original misstep was made by Regions landman, this case serves as a reminder for mineral owners too about the need for careful oversight of lease extensions.
The information and material in this episode is general information about our practice and firm and is for educational and informational purposes only. This information does not offer specific legal advice, and the use of this information does not create an attorney-client relationship with RRNA or any of its attorneys. The information in this episode, or any episode of An Ounce of Prevention, should not be considered legal advice, and persons should not act upon this information without first engaging professional legal counsel.
Thank you for listening to An Ounce of Prevention, presented by R. Reese & Associates. If you found this episode informative, subscribe to, rate, and review our podcast on Spotify, Apple Podcasts, YouTube, or wherever you listen to stay up to date with future episodes, case law updates, and breaking news. If you have any questions or are interested in learning what RRNA's outsourced legal department can do for your company, reach out to us at podcast@rreeselaw.com. That's podcast@rreeselaw.com. Follow us on LinkedIn or call 832-831-2289.